Multifamily case study time. How my wife and I bought this 16 unit apartment for $1.3 million through what we call the strategic value add play. We made the deal worth $1.9 million in just over a year later. We put $260,000 down to buy the deal. We were able to cash out refinance $280,000, producing an infinite return. I'm here to teach you our strategy so you can get in this game, because we know if you buy one small multifamily deal, it will change you and your family's life. I'm here to give you the blueprint to get started. Let's get into it. Okay, so let's talk about multifamily basics. If you're new here, this is the math that you need to know. A lot of newer real estate investors get very confused with underwriting and deal analysis. Guys, I'm here to make it very stupidly simple for you. Multifamily, you need to know two key formulas, okay? NOI, which is just your income minus your expenses, equals what? That's your profit. In multifamily, we call it NOI, net operating income. In business, it's called EBITDA, earnings before depreciation, taxes, amortization, okay? So your income minus your expenses, divided by the cap rate. When you're looking to buy a deal, a broker's gonna tell you what the cap rate is for the area. If you're here in Metro Detroit like we are, I would say the most cap rates are between 5 and, I've never really seen a 9% cap rate, but 5 to 9% equals your valuation. So if you know the NOI, you know the cap rate, you know how much the deal is worth. The magic formula that we talk about here and how my wife and I went from owning one single family home to now 258 units is this formula. We call it the magic formula for wealth creation, because this is how you can build wealth very, very quickly with multifamily. For every $1, you can increase the NOI, either by increasing the income or by lowering the expenses, which we'll talk about here. We always say you make your money in the operations of owning multifamily. $1 divided by the cap rate equals your value increase. So on this deal, it was 6.75% cap rate. So this is worth approximately $14 in valuation increase. This is what I really want to stress to you guys. If I buy a single family home, I can only increase the value based on comparable sales. So if I'm trying to sell my house for $400K, or this is 1 to 4 units, okay, residential real estate, non-commercial real estate, there needs to be comparable sales in the market to say this is worth $400,000. If every other comparable sale was around $300K, $200K, it's gonna be very hard for my home to appraise for $400,000. Multifamily is treated like a business. It's about the profit the building produces. It's about the NOI. So if you can increase the NOI, even $1, you can make $14 in valuation increase. This is why I preach to you guys. Knowing what I know now, I would skip the single family. I would get into small multifamily because it's the fastest way to build wealth for you and your family. So when it comes to increasing NOI, it's not just about raising rents. That's what everyone thinks. Like, oh, you land leeches and you slumlords, you just come in and raise rents. Well, not always. Raising rent is part of it. Listen, if someone's paying $600 and the market rent is $900, we might raise it to $800 because we have to. As we take over a building, our expenses increase. Our property taxes go up, our insurance goes up. We have to provide clean and safe housing for individuals, so it takes money to do that. If you don't want to raise rents, don't buy multifamily. It's just not the business to be in. Like, everything goes up in an inflationary society, so it's part of the game. But we do light value add. We fix up units. The number one reason a tenant will move out is not because of an increase in rent, it's because of deferred maintenance and maintenance requests that are not answered. So we definitely do that. We fix all the problems. We make sure the property is totally upkept, totally brought up to speed, and made very, very valuable. We lower expenses. The big thing my wife does, who's not here right now, but she's like the head of our operations and our management team. We lower expenses. We shop vendors. We try to bring things in-house. We have contractors now that we just have in-house on payroll. We try to bring them in and on everything we can, because when you're using a third-party company to clean your hallways, let's say we're at my 42-unit apartment right now, there's the hallways right over here. They're going to charge you a lot more than someone on a salary that's on your team. So that's very, very important. We charge for fees. A lot of times when you buy from small multifamily owners, they're not charging any fees. There's dogs living there. There's cats living there without fees. There's no late fees. There's no utility fees. So these are strategic things we look to build back on. It's not just about raising rent. It's very common in multifamily nowadays that tenants have to pay some of the utilities. Like, landlords should not be paying all utilities. So those are things we look at. We overall make our money in multifamily, and how you will make your money is by running the deal more efficiently, focusing on profit. One of my mentors early on once taught me, Tony, it's revenue that feeds the ego, but it's profit that feeds the family. If you can maximize profit in multifamily, you will make money. Okay, so let's talk about the financing. The finance is a very important part of multifamily. So on this loan, back in the day, this was a couple of years ago now, I was able to do an 80% loan to value. So that means on 1.3 million, I only had to put 20% down. Guys, I'm gonna be honest, this is not common anymore because interest rates are a bit higher. So don't hit me up and be like, hey, how do I get 20% down? Common now is more closer to 30%. We did a 6% interest rate, 0% prepayment penalty, which is huge. If you can do that, always negotiate that. It was a 25-year amortization. So this is a big thing that comes up with multifamily. People are like, how does this work? It was a 5-year term. So I had my loan for 5 years, but I was making payments as if the loan was for 25 years. And in 5 years, you either have to refinance it, sell it, which you probably don't want to do, or pay the loan off, which you definitely don't want to do. So every 5 years, it's very common in multifamily, you just refinance the loan. As you'll see here, I did it much sooner than that. So let's talk about the plan. Back to our formula on the whiteboard, NOI divided by cap rate equals valuation. That's what I mean, guys. It's very stupidly simple how easy it is to make money with this. When we took over these 16 units and they were 2 separate 8 units, the rents were around $600 a month, which if you know anything about Metro Detroit real estate, I mean, this is a great area. You can't get anything for $600 a month. Why were they $600 a month? Because the former owner had owned it for 20 years. He didn't have to keep up with market rent. He had no debt on the property. So he was able to charge much lower in rent and by way, really not have to take care of the property. Like there was a lot of deferred maintenance that we came in and fixed immediately. And then we brought the rents up so tenants saw the improvements we were making. But you'll notice that when you buy from an owner who's owned for a very long period of time, they don't have to keep up with market rents. But that's value to you because we'll talk about that magic formula in a minute here. That's how you force value. Forcing value isn't just redoing things, it's improving the profit because an apartment is appraised by the profit it produces. A single family home is appraised by the fixtures it has, the countertops it has, the amenities it has. Very different. This is where most new investors struggle to make that connection. So I want to make sure I go over it. So through strategic management, we increase that NOI from $60,000 to $125,000 in about 12 to maybe call it 18 months time. When you buy a multifamily property, it's very common for a bank now to say, we want to see post-closing liquidity, usually around 10%. So a very simple example. If a bank loans me $1 million to buy a multifamily property, they're probably going to ask me to deposit 10% of that or $100,000 with them post-closing. Why? Number one, it builds a relationship. You're not just essentially using the bank to borrow money and not depositing money. Number two, banks are not savers, they are investors. What do they invest? They invest savers' money. So here's how the bank works. So the bank is like, hey, give me your money. So we all put our money in the bank, myself included. For every $1 we put in the bank, they can lend out $9. That's how it works. So I put my $100,000 there for this loan, they can lend out $900,000. Who do they lend it to? They lend it to multifamily investors. So that's why I always push you guys. Savings a losing game. Because the bank wants you to save money, wants you to deposit money. So for every $1, they can lend it out a multiple up to 9 times. It's freaking crazy. So this is why we say savers are losers, investors are the winners. You want to think like the bank. The bank is not a saver of money. They are a collector of money. Our money to bank is a liability. When they lend out a loan, they create an asset because this asset is now paid back by the investor. This is how the game works. So now it's very common that banks are asking you to deposit some money with them after they do a loan to build a long-term relationship. It all depends on the loan. Like in this 42 unit we're in right now, I have to keep 10% with them for the lifetime of the loan. So it sucks because then essentially it's like, you can call it trapped. I mean, it's earning interest, it's in a money market account. So these are all things to consider. That's why we always say like, it's okay to partner up sometimes to get into a deal because it's not just about funding the deal, it's about post-close liquidity. And that's why really reviewing your covenants with the banks is very, very, very important. Go back to our magic formula. I'm going to show you guys again how simple this was. NOI divided by cap rate equals my valuation. So our new NOI in the building was $125,000 through everything we talked about: strategic operations, light improvements. There's 3 types of deals. There's a stabilized deal. I don't want you to buy this if you want to make money because there's no way you can increase the NOI. I took the NOI from $60,000 to $125,000. I wouldn't buy the deal if the NOI was $125,000 because there's no way to add value. There's a major reposition. Go watch on my channel. That's our 16 unit. A lot of work, a lot of headaches. Wouldn't recommend it. I made just as much money on this deal as I did a deal I had to flip 16 complete units, 16 roofs, 16 freaking the parking lot, all that. Then there's what's called light value add. That's what we focus on. That's what I want you to buy for for your first deal is a light value add. It's where I've got a 60,000 NOI. I'm in a great area. I can raise the NOI to 125,000 via operations. Divided by a 6.5% cap rate, this building now appraised for $1.932 million. What did I pay for it? $1.34 million, I believe. That is powerful. That's what multifamily can do. You can't go buy $1 million of stock and make it worth $1.9 million. You can do this with real estate. That's why we love the vehicle. That's why we feel it's the safest vehicle for you and your family to invest into, because you can control the value. So this is my new valuation. So I went back to the bank. I showed them the work we did. They had the building appraised. We were able to do a cash out refinance. We pulled out $280,000 tax-free. If you remember, to buy the deal, I only put down $260,000. So if you buy a building, you put $260,000 down to buy it. We got tax savings, we made cash flow, we had all those great things. A year and a half later, once the loan actually closed and all that, you pull out $280,000 tax-free. Why is it tax-free? Because it's debt, and debt's not taxed. What's your return on investment? Infinite, because you have no money left in the deal. This is what's called the BRRRR strategy. This is why I get so passionate. This is why I want you guys to do this. You buy it right, you renovate it. But remember, we said light value add. We did not do heavy renovations here. You don't have to do heavy renovations. Such a misconception. People think like house flippers are like, I gotta go do all the countertops. And you don't have to. I didn't do crazy renovations here. Again, deferred maintenance has to be fixed. Renovations not always. You rent it out. You improve the NOI, you refinance the deal, pull your money out so you can go repeat it. You take this and you can go buy another deal. That is the BRRRR strategy. That is why multifamily will create wealth for you. That is how you scale. Now, some people, I already know people in the comments, they're gonna be like, well, you borrowed more money, because right, you go get a loan on this new dollar amount. So I think my loan was like 1.3 million. You pay off the old loan, you get to keep the difference. That's why we say it's tax-free, because it's debt. You get the difference of the debt. People be like, but you have to go pay that back. Wrong. I don't pay any of my properties when I own multifamily. The tenants, the income the property produces pays back the debt. A bank will not let you cash out refinance if there's not cash flow to pay it back. They won't do the deal. That's why I love multifamily. They won't let you do a deal that does not cash flow. They will not finance that deal. Single family, when I own single family homes, and the worst number in business, folks, is 1. Always remember that. If your one tenant moves out, you have no tenants. You are paying that bill there. On 16 units, there's enough income from the property to pay all the debt back, to cash flow, to pay the maintenance, pay the taxes, pay the insurance. When you own multifamily, you do not pay the debt back. The property pays the debt back. Assets paid off by other people is the way to wealth. So like I said, that's the multifamily BRRRR method made simple. I love showing you guys real case study examples, because I'll be honest, when I got in this game, I searched far and wide on YouTube and I wanted to see real people, not just talking about it, but living it. The beautiful thing about multifamily is this is all factual. Like, you can go fact check this. You can go like see my property, see that this happened. You can go like, if you want to be crazy, you could go find the bank and the loan. All of that's like publicly disclosed, right? So this is the ultimate way to build wealth for you and your family. My wife and I have done this 100% cash out refinance process 5 times since 2021. And I'm here to help you get in the game. So hopefully this case study was inspirational for you. If a former registered dietitian like myself, who lost my mother early on, grew up on food stamps, was on reduced lunches, had a freaking bridge card, and my wife, who was a former school teacher, if we can do this, you can do this. So as always, if this was beneficial, drop a comment in the comment section. If you've made it this far, I would love for you to leave a meaningful comment. If you have questions about anything we talked about here, I'm here to help you get in the game. Drop a comment. If you want us to work with you one-on-one to help you buy your first small multifamily deal like this and run our proven blueprint and process to improve the property, fix it up intelligently, not overspend, not overdo it, and be able to do a 100% cash out refinance, click the link in the description. We do offer mentorship and coaching where you get to work with real owners and operators who live it and breathe it every single day to help you get in the game. I have tons of free resources as well. If you're new here, be sure to subscribe, because we're all about helping you buy your first small multifamily deal. Till next time, we'll talk soon. Thanks.